Have you ever heard the phrase, when in doubt, zoom out? Most of us have heard this phrase before, but how does it apply to the equity markets? Do you follow one stock market index to see how the equity markets performed? Most people only look at the Dow or the S&P 500, but does this give you enough information? If you're one of those people who measures the success or failure of the stock market by looking at just one index, you're shortchanging yourself and not getting a true picture of what's really going on. Sure, a quick glance at the Dow or the S&P 500 will tell you if that index went up or down for the day, but what's the point? If you're one of those people, you're missing a full understanding of what's going on in the equity markets. And if you're only looking at the equity markets, then you're missing a full understanding of what traders and investors are doing with their money and what it could mean to you. Here's an example. The Dow finished the day lower. Was it a bad day for the markets? Here's another example where equities were up for the day, but treasuries were down. Is this good or bad? The problem with looking at one index on one day is it will either make you feel good or make you feel bad. But other than those two outcomes, you'll get no additional information out of it. When in doubt, zoom out. If you take a few extra seconds to look at the bigger picture for the day, you'll get much more information about the current state and sentiment in the equity, treasury, commodity, and crypto markets. But more importantly, the interaction between these segments holds important information about what's really driving the markets on any particular day, or even better, a given month. Do you typically follow the Dow or the S&P 500, or do you look across the markets to understand what's going on? Or do you just watch my weekly market review videos to find out? Please let me know in the comments below. With all that, let's go through the current health of the stock, bond, gold, and crypto markets. Well, if we look back over the past week, you can see it's been a pretty rough ride here. You've got equities pulling back on Tuesday, kind of flat on Wednesday, a little bit down on Thursday, and then shooting higher on Friday. What about over the past month, though? This is why it's important to zoom out. You can see we have a very healthy appetite for equity risk, with ARK Innovation at the top by a large margin, NASDAQ 100 in second, S&P in third, small caps just behind the S&P, and the Dow dead last. That's almost an ideal relationship. And what if we look at year to date? Well, you can see ARK has been struggling, as it has been for quite a while, but you can see that the NASDAQ and the S&P are right up here at the top, followed by the Dow, followed by small caps, which have also been struggling somewhat lately. And then if we look back over even a slightly longer period, over the past year, you can see that the NASDAQ and the S&P are at the top. The Dow and the small caps are basically roughly tied. And then ARK Invest is kind of lagging behind here. But you can see that when ARK Invest rallies, the slopes are much higher than these other ones. So if we get a good, healthy rally going on for any length of time, ARK Invest should pass up these other ones. And how does all of this show up in the current bottom dynamics? Well, if we take a look at the bottom dynamics, you can see, well, it's been a rocky ride, but in general, the price of the S&P 500 has been moving higher. Now, recently, the bottom confirmation signal, the solid blue line, fell off. The bottom forming indicator started moving higher, which is typically happening during kind of rough periods. And you can see that the market pulled back a bit here. But now, recently, they've switched positions, and the bottom confirmation signal is moving higher as the confidence level is moving higher. Hopefully, this says good things going into next week. But I'm not so sure as we look through the rest of the metrics. So if we look at risk versus opportunity, I don't like this. I don't like that risk acceleration has started moving higher and is approaching 60. When it gets above 60, it's usually not a great thing. And look at opportunity acceleration. It went the opposite direction here, even though there was an up day on Friday. This is not looking great to me. And what about equity versus safety? Well, let's jump right into the overlays. If we look at what's been happening here, you can see that a couple of weeks ago, equities were down here in the bottom half of the table. And then last week, they moved up into the top half of the table and have stayed there, which is great. And cash has stayed put. So it looks almost like nothing has changed from last week to this week. Well, if we look at safe haven assets, that's almost true, but not quite. You can see gold stayed put, cash stayed put. And I like the fact that cash is in the bottom half of this table, which is where I like it. But you can see the intermediate bonds fell and short duration bonds improved. So this is not a healthy treasury appetite here. And how does this show up in the buying and selling pressure? Well, this is one of the areas where I see there might be some risk going into next week. So let's jump into some overlays here to talk about that. You can see that the Dow has been moving higher. The S&P has been moving higher. NASDAQ 100 has been moving higher. And small caps have actually been moving lower lately. But what concerns me here? Well, you've heard me talk about divergence. When you have increasing price, decreasing buying pressure, and increasing selling pressure, that's a divergence. That's a conflict. Usually you want to see increasing price like back here with an increasing buying pressure. That's very healthy. When you have increasing price and decreasing buying pressure, that's not healthy. And you can see that's happening with all the indices except for small caps, where there isn't a divergence here. The price is dropping, the buying pressure is dropping, and the selling pressure is increasing. Unless this turns around, it's not looking good for next week. And what about ARK Innovation in all of this? Well, somewhat of a similar picture here. You've got rising price and falling buying pressure and increasing selling pressure. And you can see that eventually it capitulated and the price started dropping. Now, it started going higher on Friday, but if the rest of the markets hold, I'm not so sure this will do well next week. But we'll have to wait and see. There's no crystal ball. So how does all of this risk or opportunity show up in the sector rankings? Well, I'm going to jump ahead to sector rank acceleration because these react a little more quickly and kind of give you less lag in the indications. It's kind of more of a picture of where we are or where we might be headed versus where we've been, which is what you see in sector ranks. So let's jump right into the overlays. There's a lot that looks good here, a lot. You can see that aerospace and defense moved down a couple of notches and gold moved down several places. This is good because there's a lot of geopolitical risk in the world, and the markets are saying, well, maybe it's not as bad as we thought, and these are starting to back off. We've got emerging companies, the smaller NASDAQ 100 companies staying put, so I gave that a yellow line. The Dow moved up slightly. Now this is brown because these are safer stocks. So I like the fact that they moved up, but I don't like the fact that they moved up because they're safer places to be. Now consumer staples moved down a lot. Now again, these are equities. So the fact that they moved down a lot is bad for equities, maybe, but they're also the safest equities. So I like the fact that these are pushing lower while all these higher risk categories are moving up, like emerging markets, small caps. We've got the NASDAQ 100 moving up. We've got Bitcoin moving up. Consumer discretionary moving up. Cash staying put. We've got the S&P 500 moving up. And we've got 20-year treasuries kind of staying put here. So these are all looking really good. What doesn't look so good? Well, not much. You've got ARK Innovation moving lower. You've got semiconductors moving lower. And you've got the technology ETF XLK moving lower. Now, I'm not really sure of this, but I'm guessing if we go and look at XLK's top holdings, I would almost begin to bet that the semiconductors are a big chunk of that. In fact, let's do that. Let's take a look at their top holdings and see what's in there. Okay, so this makes sense. If we look at the top holdings of XLK, you've got NVIDIA, semiconductors, AMD, semiconductors, but those are the only two. So there must be more to the picture than what I thought, but these two, if they fell a lot on Friday or over the last several days, would give you some sense of that. So let's take a look at them. So if you look at the price action of NVIDIA, yeah, it's been pretty rough. In fact, generally down over the last 3 months. And let's look at AMD. And if we look at AMD over the last 3 months, very similar picture, a really rough ride and generally down. And what about Treasuries? Well, if you look at Treasuries over the last 5 days, it's not been good. You can see that they've just gone down, down, down. Now, is this bad or is this good? This is my point of this video. This is the entire point of this video. So Treasuries are down and equities over the last 5 days, now they're up, most of them, but you can see that on Friday they moved up in a big way. So is this bad or good that Treasuries are down? Well, to me, this tells me that investors or traders are selling Treasuries in favor of riskier assets like equities, especially on Friday. And you can see that here. These really fell off on Friday, and these really went up on Friday. So kind of makes sense. Now, that's in contrast to what I'm seeing in some of the other metrics. This would tell me, hey, we're in for a good week next week because investors and traders are selling Treasuries and putting their money into equities. Now, if that continues next week, equities will go up and Treasuries will continue to go down, possibly. But if the metrics are giving me the indications I think they are, we could be in for a choppy ride next week. And how do Treasuries look over the last month? Well, again, very similar picture. They've really been struggling lately. And then if we look at year to date, you can see what's been happening here. We had a bottom back here, a very, very nice rally, and then a collapse. But if we look back over the last year, Treasuries are still higher than they were a year ago. So this is showing a good risk appetite for Treasuries with the longest duration at the top, 20-year bonds here, and so on, even though they've been falling off recently. And how does this show up in the buying and selling pressure? Well, let's jump into some overlays. So if we look at overlays, this does not tell a good picture for Treasuries. Okay, so what does this say about Treasuries? Well, good and bad. You can see that we had divergence here. In all cases, we had rising price, falling buying pressure, rising selling pressure in every single case here. And what happened after that? Well, the prices fell off. Now, how does that look for what I call sort of intermediate to long duration Treasuries? Well, we have another potential divergence here, a shorter one. The selling pressure is falling off as the price is falling, and the buying pressure is rising. So this, and you can see that here in the 20 years, rising buying pressure, falling selling pressure, falling price. So there's another divergence right here that I didn't outline with overlays, but this looks really good for long bonds going into next week. Well, and what about the yield curve? Well, the yield curve really showed some signs of improvement in the last few weeks, but you can see that it's moving a little bit more toward being inverted again. We're only 4.34 basis points not inverted. So if the 2-year rates continue to move higher, as you can see they've done here over the last month, the red line is a month ago, the blue line is now, and you can see that they have moved higher. We're going to have an inverted yield curve again. Now, this is the markets reacting to the strong jobs report and a fear that the Fed might not lower rates as aggressively. But we'll see what happens. And how is the Fed rate monitoring tool looking? Well, you can see that after that jobs report on Friday, this became more likely. In fact, you can see it here. There was almost no likelihood that the Fed would keep rates where they were until the jobs report came out. And now it's all of a sudden 7.1%. But I think the markets in general expect that the Fed is going to lower rates at least 0.25%. Now, there's no indication here that the market thinks they're going to lower them 0.5% as they did just a day ago. But when we go out to December, now all of a sudden, there's a very high likelihood that we'll be at least 0.5% lower than we are now. And a growing possibility that we might even be down 0.75%. What if we go out to January? Well, in January, more likely that we'll be down 0.75% and possibly 1%. So Look, if inflation continues to moderate and the economy stays strong, there's no reason the Fed shouldn't lower rates to their target rate of 2.8%. And as you can see, we're a long way from that right now at 5%. So they have a lot of rate reductions to go here. And what about gold? Well, with all the geopolitical risk lately, you can see over the last 2 months, gold has been really moving higher. But there is a divergence here. You can see that the price of gold rising, but the buying pressure falling. And what happened? Well, when you have that kind of divergence, and by the way, the selling pressure was rising here, you can see that the price of gold has pulled back recently. And what about Bitcoin? Well, kind of slightly up to nowhere. I mean, you can see a very rocky ride here over the last couple of trading days. It moved higher, but it moved higher on Friday while the buying pressure declined. Now, over those 2 days, the buying pressure is higher and the selling pressure is a bit lower. So, not enough information here to really determine what's going to happen with Bitcoin over the coming weeks. As you can see from the price movements and metrics for equities, the equity markets have really struggled lately. But the flight from safe treasuries this past week into riskier equities could be a good sign for the equity markets next week. This is why I caution you to be an investor rather than a trader who tries to time the markets. Investments and investing aren't that complicated if you know how to allocate your portfolio without destroying your returns and getting little to no protection from downside risks. As an investor, you need to take the long view and allocate according to your risk tolerance rather than fretting about what's currently happening in the world or what everybody else is doing that you read about in the media with their portfolios. If you want to be a better investor, I discuss how to allocate your portfolios in 2 key videos linked in the pinned comments below, titled The Ideal Portfolio Using Just 2 ETFs or Mutual Funds, and The Ideal Portfolio Using Individual Equities. Again, link in the pinned comments. Until next time, I'm Calvin Rose, and thank you for watching Invest Smarter. That's all for now.
Stay up all night, gotta work now. Make up my mind and it turns around. Say that I'm fine till I burn out. Thinking this money sounded so nice. Ambush here in the strobe lights. Pay anything for the high price. This life feels like the sunny water.